Hello friends, welcome to the third video of the chapter Accounting for Partnership Firms Fundamentals. In the previous two videos of this chapter, I have discussed almost all the basics of the chapter, starting from the partnership, its meaning, features, the rights and the duties of the partners, partnership deed and its contents, provisions applicable in case of absence of partnership deed. In the second video, I have discussed with you about the profit and loss appropriation account, its features, the specimen of profit and loss appropriation account, journal entries required for profit and loss appropriation account, interest on loan of a partner, rent payable to the partner, what if the appropriation is more than the available profit, and then at the end, like the difference between the charge against profit and appropriation of profit, and the difference between profit and loss account and profit and loss appropriation account. Now, in this third part of the chapter, we are going to learn the various special aspects which are required from the numerical point of view, like what about partner's capital account, partner's drawings, salary, commission to a partner, interest on capital, interest on drawings, interest on loan, past adjustments, guarantee of a profit. Let us see the special aspects of partnership accounts. Number 1, partner's capital account. 2, partner's drawings account. 3, salary or commission to partners. 4, interest on partner's drawings. 5, interest on partner's capital. 6, interest on partner's loan. 7, capital ratio of partners. 8, past adjustments or adjustments in closed accounts. And finally, guarantee of profit to a partner. These are all the various aspects that we need to learn in this chapter. Let us know something about partner's capital account. How are partners going to maintain their capital accounts? The partners' capital accounts may be maintained by following any of the two methods. Number 1, fixed capital account method, and number 2 is fluctuating capital account method. In fixed capital account method, the capital invested by each partner in the firm remains fixed or unaltered unless a partner introduces additional capital or withdraws out of his or her capital. When fixed capital account method is followed, two accounts, that is capital account and a current account for each partner are maintained. Let us see about the capital account. Capital account of each partner continues to show same balance year after year and changes only if number 1, additional capital is introduced which is credited to capital account, and second, withdrawal is made out of capital which is debited to capital account. These are the only two cases where the fixed capital account changes. One, at the time of additional capital, and second, withdrawal out of capital. Next, current account. Current account is maintained to record the transactions other than the transactions relating to capital account, such as drawings against profit, interest allowed on capital, interest charged on drawings, salary or commission payable to partner, and share of profits or losses. That means, apart from capital, if any other adjustment is there related to partner, has to go to current account. As a result, the balance of current account fluctuates with every transaction with the partner. If we allow interest on capital, partner's current account balance will increase. If we charge interest on drawings, partner's current account balance will decrease. That's why you are told that the balance of current account fluctuates with every transaction with the partner. Current account of each partner is debited with the following amounts. Drawings by a partner against profit We will learn in detail drawings can be in anticipation of profit and drawings can be out of capital. But the drawings which are made by the partner against a profit are to be debited to current account, and drawings out of capital needs to be debited to partner's capital account. Interest on drawings is to be debited, share of loss, and transfer of any amount to capital account permanently. So these are the amounts which are debited to partner's current account. Now let us see. Partner's current account is credited with interest on capital, which we allow to the partner. Salary or commission, again it is allowed to the partner, which will increase partner's current account balance. Share of profit and transfer of any amount from capital account permanently. If you transfer some amount from capital to current, the amount of current account will increase. Normally, partner's current account has a credit balance. But if a partner has withdrawn more than his or her share of profits, then it will have a debit balance. The balances of partners' capital accounts are shown on the liability side of the balance sheet as that much is due to them. The partner's capital is a liability, so it has to appear in the balance sheet on the liability side. Credit balance in current account is shown on the liability side. Debit balance of current account will appear in the balance sheet on the asset side. Fluctuating capital account method. This is the second method of maintaining the capital account. Under fluctuating capital account method, only one account, that is capital account, is maintained for each partner. Everything, including the capital and the adjustments, will be recorded in this account only. All transactions of partner, for example, capital introduced or withdrawn, salary or commission, interest allowed on capital, drawings, interest on drawings, share of profit or loss, etc. are recorded in his capital account. And as a result, balance in the capital account fluctuates with every transaction. Capital accounts having credit balances are shown on the liability side, while capital accounts having debit balances are shown on the asset side of the balance sheet. This is what is very much similar to current account. Current account debit balance in balance sheet on the asset side, and current account credit balance in balance sheet on liability side. Fluctuating capital method is normally followed for maintaining capital accounts, and therefore in the absence of any instruction, this method should be followed for maintaining the partner's capital account. Let us go through the difference between fixed capital account and fluctuating capital account. Number of accounts. Under fixed capital method, we prepare two accounts, that is fixed capital account and current account. Whereas under fluctuating capital method, we just prepare one account. Frequency of change. In fixed capital account method, fluctuations doesn't take place very often, but it will change only if further capital is introduced or capital is withdrawn. But under fluctuating capital method, the balance changes with every transaction of the partner. Recording of transactions. Transactions relating to capitals are recorded in fixed capital account, and transactions for drawings, interest on capital, salary, commission, share of profit or loss are recorded in current account. Whereas under fluctuating capital method, all the transactions are recorded under the same account, that is capital account. What is the balance shown? Fixed capital account will always show a credit balance, whereas fluctuating capital account can show a debit balance or a credit balance. Partners drawings account. The amount withdrawn by partners from the firm in anticipation of their profit share to meet their domestic expense is called drawing. At the end of the accounting period, drawing account is transferred to the debit side of partner's capital account or to partner's current account. If it is a fixed capital method, we transfer to current account, and under fluctuating capital method, we transfer to capital account. The entries that we pass for withdrawal of amount from the firm: partner's drawings account debited to cash or bank or purchases. If the amount is withdrawn in the form of cash, or if the amount is withdrawn from bank, we credit cash or bank. And if goods are withdrawn by the partner, in that case we credit purchases account. For transfer of partner's drawings account to partner's capital, drawings account, we know like it has a debit balance. When we close this account, we need to credit it and debit partner's capital account. You can see there partner's capital or current account debited to partner's drawings account. If a partner has withdrawn his capital for meeting his personal needs, it is called partner's drawings against capital. You can see there the amount has been withdrawn out of his capital, right? So we say that this drawing is against capital. And the entry passed will be partner's capital account debited to cash or bank or purchases. Thus, we have two ways of drawings: withdrawal of capital, that is drawings against capital, and second, withdrawal in anticipation of profit, that is drawings against profit. Difference between drawings against profit and drawings against capital. Where do we debit this? Drawings against profit will be debited to drawings account, whereas drawings against capital will be debited capital. Drawings against profit is a part of the expected profit, whereas drawings against capital is a part of capital. What is the effect? Drawings against profit will not reduce the capital, but drawings against capital is going to reduce the capital. Interest on drawings. For calculating interest on drawings, drawings against profit is considered, whereas drawings against capital will not be considered for calculating interest on drawings. Interest on capital. When you have to calculate interest on capital, drawings against profit will not be considered, whereas when you have withdrawal out of capital, so yes, that amount will be considered for calculating interest on capital. Interest on partner's capital, a very important point of the chapter. Interest on capital is allowed to compensate a partner for contributing a capital to the firm in excess of the profit sharing ratio. It is computed at the agreed rate with reference to the time capital has been used in the business. Interest on capital is computed on the opening balance of the partner's capital. If additional capital is introduced during the year, interest is allowed on it for the period it has remained in the business, that is, from the date of the additional capital is introduced till the end of the accounting year. Similarly, if capital is withdrawn by a partner during the year, interest is not allowed on the amount of capital withdrawn. Provisions relating to interest on capital. First one, when the partnership deed does not exist or partnership deed does not have a clause as to interest on capital, we know very well that interest on capital is not to be allowed. Interest on capital is not allowed. When the partnership deed provides for interest on capital but is silent as to the treatment of interest as a charge or appropriation, in that case, interest on capital is treated as an appropriation of profit. Interest on capital is allowed only if there is profit. Do remember the first 2 points. If partnership deed does not exist, interest on capital is not allowed, and if the deed is silent about the treatment of interest on capital, then we need to take it as an appropriation, and being an appropriation, it will be allowed only if there is a profit. There are 3 possibilities. Number 1, in case of loss, interest on capital is not allowed. In case profit before interest is equal to or more than the interest, in that case, interest on capital is allowed at the agreed rate. Third, in case profit before interest is less than the interest, in that case, interest is allowed only to the extent of profit in the ratio of interest on capital of each partner. When the partnership deed provides for interest on capital as a charge means interest on capital is treated as a charge against profit. We very well know that any amount which is a charge against profit has to be provided for even if the firm incurs a loss, and charge against profit has to go to profit and loss account. Interest on capital is allowed whether there is a profit or loss. Interest on capital when profit available for appropriation is inadequate. A very important point. The profit of the firm may be less than the amount of interest on capital allowable to the partners. In such a situation, interest on capitals of the partners is calculated and the profit is distributed among the partners in their ratio of interest on capital. In case, besides the interest on capital, appropriation is to be made for salary and commission, etc. to partners, total appropriation for each partner is determined and the amount is distributed among the partners in the ratio of the appropriations to be made to each partner. This point we have discussed in the previous video also. Interest as a charge means interest on capital is to be allowed whether the firm has earned a profit or incurred a loss. Profit and loss appropriation account should not be prepared because interest on capital is treated as a charge against profit. Opening capital. We need to remember that whenever you are allowing interest on capital, so this interest has to be allowed on opening capital only. But what if the opening capital is not given? In that case, it is determined by adding those items which have already been subtracted, that is share of loss, drawings, interest on drawings, and by subtracting those items which have already been added to the capital, that is additional capital, interest on capital, and the profit already credited. For calculating opening capital, drawings are to be added. However, if drawings of partners appear in balance sheet, it means that their capital accounts have not been adjusted with respect to their drawings. It's also a very important point when you start solving the sums and all. Please see that if drawings do appear in balance sheet on the asset side, it means that their capital accounts have not been adjusted against drawings, so it will not be added back. Interest on partners' drawings. Drawings means the amount withdrawn in cash or in kind by the partners for their personal use. If the partnership deed so provides, interest on drawings is charged. The entry passed is for interest on drawing, partner's capital or current account debited to interest on drawings account. And for closing interest on drawings account, we know it's an income, so credited to P&L appropriation account. Entry interest on drawings account debited to profit and loss appropriation account. Calculation of interest on drawings. Drawings by partners may be broadly divided into irregular drawings. It means that the drawings of the same amount or different amounts at irregular intervals. The amount is not fixed, the date is not fixed, the interval between the two drawings is not fixed. Second, the regular drawings. All these features will be observed here. It means drawings of same amount at regular intervals. Interest on drawings. When drawings are made at irregular period or of different amounts, product method of calculating interest is followed. In case of irregular drawings, product method to be followed. And when drawings are made of the same amount at regular intervals, interest on drawings is calculated using average period method. Please remember, in case of irregular drawings, product method. In case of regular drawings, average period method. Product method. Under this method, the amount of drawings is multiplied with the number of months or number of days, as the case may be. It has been used. The product so obtained is totaled and interest is calculated thereon for 1 month if the period taken is in months, and for 1 day if the period is taken in days. Very important, please take care. Under product method, the number of months to be taken is 1 if the calculation is in number of months, and If it is in number of days, then 1 day only. What is the formula to be used? So you can see there, interest on drawings is equal to total of the product into the rate of interest upon 100 into 1 by 12 if it is in number of months, or otherwise it can be 1 by 365 if it is in number of days. Average period method. This method is used when there is regular drawings or when the amount of drawings is uniform and the time interval between the two drawings is also uniform. The formula over here, you can see there the total drawings into the rate of interest upon 100 into the average period by 12. Very important to know how this average period is calculated. To calculate average period, the formula you can see there, the months left after first drawings are added to the months left after the last drawings and then divided by 2. We need to take an average, so divide by 2. Let us see the table, how to memorize this. You can see there I have mentioned the amount withdrawn. It can be in the beginning of the period, in the mid of the period, or at the end of the period. If the amount is withdrawn every month, then in that case the average period to be taken in the formula will be 6.5 for the beginning, 6 for the mid, and 5.5 for at the end of the month. And if the amount is withdrawn every quarter, 7.5 is the number of months to be taken if the amount is withdrawn in the beginning of the quarter, 6 months in the mid, and 4.5 at the end. The amount is withdrawn every month but for 6 months only. The average period you can see there, it is 3.5, 3 and 2.5 respectively. If the date of withdrawal is not given, then interest on total drawings for the year will be calculated for 6 months on the average basis. If it is a period of 12 months, then only the average period of 6 months to be taken, right? If the date of withdrawal is not given. But if the date of drawings is not given and the accounting period is less than 12 months, then the interest on total drawings is calculated for half of the accounting period. Say for example, the accounting period is 9 months. So in that case, the average of 9 months will be 9 by 2, that is 4.5 months. When the rate of interest is given without the word per annum, in that case, interest is charged without considering the time factor. Interest on partner's loan to the firm. Though like we have discussed it earlier also, let us go through once again. Every partner is entitled to interest on loan provided by him at an agreed rate. In the absence of partnership deed, interest on loan given by any partner be allowed at the rate of 6% per annum, whether there is profit or loss in the partnership firm. Interest on partner's loan is a charge against profit and not an appropriation out of profits, so it should be debited to profit and loss account. The entries that we pass for interest on loan. To provide interest on loan, we know like interest on loan is an expense, so debit, and loan account needs to be credited. Entry is interest on partner's loan account debited to partner's loan account. The second entry, when you close this, we already have gone through interest on partner's loan is a charge against profit, and being a charge against profit, it needs to be debited to profit and loss account. So the entry is profit and loss account debited to interest on partner's loan account. Salary or commission to partners. When you allow a salary or commission to partners, it is an appropriation and to be debited to P&L appropriation account. Salary or commission to a partner is an appropriation of profit and not a charge against profit. Salary payable to each partner is normally stated as an amount, but still you need to take care how is the salary payable every month, every quarter or annual. Please take care while solving the sums. But commission payable to a partner is stated as a percentage of profit, and that can be in two ways, which may be allowed to partners either as a percentage of net profit before charging commission, or it can be as a percentage of net profit after charging commission. Let us see how the commission is calculated. Salary or commission is an appropriation of profit and therefore it is debited to profit and loss appropriation account. Commission is computed as follows: percentage of net profit before charging his commission. In that case, whatever the net profit is there before commission into the rate of commission upon 100. But what if it is a percentage of net profit after charging his commission? In that case, the net profit before commission is to be multiplied by the rate of commission and to be divided by 100 plus the rate of commission. So for example, if the rate of commission is 10, so it will be 10 upon 110. What is the accounting treatment? For allowing salary or commission to a partner, we know it's an appropriation of profit, so we have to debit it to P&L appropriation account. But the first entry required is partner's salary or commission account debited to partner's capital or current account, and then when you close account, it has to be debited profit and loss appropriation account, and you can see the entry over there, profit and loss appropriation account debited to partner's salary or commission account. What do you mean by past adjustments? Sometimes after closing the accounts of a partnership firm, some errors or omission in the accounts of earlier years are found. For example, interest on capital or drawings is omitted, allowed or charged at a higher or lower rate, profits or losses are distributed among the partners in the wrong ratio, and so on. So instead of making alterations in the closed accounts of the firm, it is decided to pass an adjustment entry in the beginning of the next year. Usually, following types of mistakes may take place. Interest on capital is omitted, interest on drawings is omitted, salary or commission payable to the partners is omitted, error in the profit sharing ratio is changed with retrospective effect. What if the manager is admitted as a partner with retrospective effect? In that case, profits for those years, interest paid on loan, if any, etc., is adjusted to give the effect to the terms of partnership. A separate entry for each adjustment may be passed, but a simple method would be to pass a single entry for the net effect. Guarantee of profit to a partner. A new partner or partners may be admitted in the firm with minimum guaranteed profit from the business. The profit may be guaranteed to an existing or incoming partner by all the remaining partners in an agreed ratio, or one or more of the existing or old partners. When the guaranteed partner's share of profit is more than the guaranteed amount, his actual share of profit is given to him instead of guaranteed amount of profit. Accounting treatment of guarantee of minimum profit to a partner in case of loss. Very important. It is possible that the firm has incurred loss, but minimum guaranteed profit is to be paid to the partner who has been guaranteed minimum profit. In such case, adjustment is made through partner's capital account in the following manner. Distribute the loss among the partners in their profit sharing ratio, and then capital account of the guaranteed partner is credited with the guaranteed minimum profit plus the amount of loss. Now, the total amount is debited to remaining partners in their profit sharing ratio or to the debit of the partner who has guaranteed the minimum profit. Minimum earnings guaranteed by a partner. This is a reverse case. A partner has given a guarantee to the firm of the minimum profit. In such a situation, the shortfall in earnings is debited to the concerned partner's capital account or current account if they maintain a fixed capital method. Thank you so much. Please like, share, comment and subscribe my channel. God bless you all.